So if we are at the end, if this is what it is, then I don't think anybody can tell you what the other side is going to possibly look like because of the specter of the credit markets being as big as they are. So you're talking about, I don't do hyperbole at all, but if this really is the end, and we really are going to see real rates rise appreciably, then you are talking about a global depression.
And of a synchronized and macronomic scale. I mean, it does feel that we're getting very close to a debt reset, and new systems may come on. Tell us a little bit more about, there's been a lot of announcements and movements that have happened. I mentioned to you, we've seen on the currency side, the Japanese currency losing an immense amount relative to almost across the board. And they've been talking about curve control. The ECB has hinted that they might do some curve control while America is tightening. You mentioned a beautiful phrase in our preamble that debt markets, and I refer to their overlap relationship with currency markets, there certain federal or ECB or central banker decisions on the debt market. The FX market is almost a release valve. Talk to us a little bit more about that, because I love that phraseology and what it means.
So it really is just, if you can just imagine, if there's too much pressure that's building up in a scientific way, either you're going to have an explosion or you're going to have a reaction. You're going to have some way to release that pressure, and the conduit, the transmission mechanism is always going to be your currency. As long as your currency is theoretically something that is publicly visible, something that can be traded. And of course, people, they don't appreciate that the FX markets are by far the largest on the planet. They supersede anything that you could possibly compare them to, whether it be in the fixed income or the equity markets.
Absolutely valid and true. And something else we were also discussing preamble was there's almost a bipolar signaling service. We have the VIX on the equity side, and the equity markets seem to be in a stupor and a slumber where they're not seeing the interconnectivity of the financial system, because on the move, the MOV, which is the volatility index for those that are just checking in, we're seeing an incredible increase in the volatility as a result of the debt markets. What is the markets missing? Why aren't they seeing? Why is there no response?
Well, I think part of it has to do with the fact that you really have, especially on the fixed income side, you've lengthened your maturities to a certain extent where credit is the riskiest. And because of that, you're starting to see EM blow up, emerging markets blow up more rapidly than, say, the junk bond market in the United States. Certain countries have less room, less wiggle room, but there is indeed $1 trillion worth of non-financial corporate debt that has to be refinanced in calendar year 2022. And I would argue that though we're not seeing defaults and we're not seeing the onset of what we would consider to be a default cycle, we will indeed start to see a lack of a release valve, if you will, if the issuance markets don't behave. And what we're watching right now is issuance kind of treading water. High yield issuance is not necessarily wide open, but it's also not closed in the same way that it did in 2018, which gave Powell, you know, such a fright that I argue that it scarred him. We're not seeing that yet, but the MOVE index is saying it's coming and be prepared. And the stock market is saying, no big deal, we're going to ignore it. And again, every single time we see a tick up in rates and nothing happens, nothing is transmitted through to the equity markets, you'll have one more Fed speaker come out and be that much more hawkish. And they're trying to push the envelope of tightening without actually having to tighten. They're trying to jawbone their way into tighter financial conditions. And the stock market is basically saying, no. They're saying, no, not until you prove it will I actually react. Not until you remove liquidity from the system through quantitative tightening will I throw a fit, because until then, the most I've seen is 25 basis points. Come check back with me again. And so then they'll throw Bullard out and he'll say, oh, we need 75 basis points. Until the stock market sees actual action, it's not going to react. The bond market, however, is reacting to the reality of higher interest rates.
It sounds like you're describing a game of chicken. where literally two truckers are going head on, and one of them is saying, I'm going to do this, and the other one is saying, I'm not listening to what you say, I'm listening to what you actually do. You're 8% behind and you did a quarter point. That tells me you're ambling after a bullet train that's long left the station and you're never going to catch it, and it's not your intention.
And Jay Powell danced around the question at the IMF. He was asked pointedly, were you one of those many who you just said many on the committee were advocating for a 50 basis point hike? And he said, well, I certainly wouldn't reveal my own position. So he did the dance. And he said, but there were many who were advocating for 50 basis points in May, and May could very well be appropriate. It's on the table for sure. And then he kind of walked a bit and said, of course, going forward, it will be a meeting by meeting decision. And that's what the stock market hears. And that's why stocks are relatively so much more well behaved than the worst first quarter we've seen in the bond market since 1973.
It feels like the Fed has two girlfriends, one in the debt market and one in the equity market, and is trying to keep them both sweet by talking a different tale out of different sides of their mouth. I find that hysterical. You were starting to touch on the debt, especially the high yield debt market. I mean, last time, it was 2018 you described, I actually had a fistful of puts on HYG, only to have the abnormal event of the Federal Reserve standing behind the HYG high yield. And just preamble, when we were having a pre-chat, I mentioned, will they do it again? Or could I be stacking up on that position again on the basis that debt needs to go down? We've got this macro view, of course, of debt short and macro long on the commodity section. Of course, deflationary strikes will tame the commodity market to a degree if we are to have the full spill. But inside of that, what will be different this time that makes that trade possibly a viable one?
So I think I'm going to give you a bit of a history and humanities and demographic lesson. Your average senator in the United States is somewhere in their mid-60s, about 20 years older than your average American. That makes a difference. The reason that is because we don't have term limits imposed upon our politicians. It's been very harmful to the U.S. economy because we haven't had people in positions of leadership who've been able to stand up to the Federal Reserve over multiple generations. So the damage that Greenspan did, the damage that Bernanke did, Yellen, who followed him, she's still doing damage right now. This comes down to the fact that you can dust off members of Congress, except for Pat Toomey of the state of Pennsylvania. Pat Toomey has committed himself to term limits. He is the one who stood in front of Sarah Bloom Raskin recently and caused the Senate Banking Committee to walk out every time they tried to vote on somebody who wouldn't provide information. And so he wouldn't push forward with a confirmation hearing of somebody who wouldn't do full financial disclosure because they were going to be voting for her to be the banking regulator of the nation. And so that was Pat Toomey. In December of 2021, before Trump was leaving office, right before he signed that final bit of stimulus that gave that second stimulus check out, there was a stipulation inside of that legislation. Pat Toomey wrote it himself. He was the author. Again, he leaves office in 2022. He's committed to term limits, so he's able to do things that other politicians who are beholden to their lobbyists and their donors are not able to do. And he said, we must turn off the credit facilities at the Federal Reserve. You're not going to do a blue state backdoor bailout with that municipal bond facility by flipping it back on and off at need. Oh, look, Illinois or New Jersey, they're going to blow up to Kingdom Come because their pension system's so underfunded. At the same time, he took out of operation the credit facilities that blew up your puts and said, and it's written into the law, if you are to flip this on, whoever the incoming Treasury Secretary is going to be. We didn't know at the time. We do now. It's Janet Yellen. Whoever that Treasury Secretary is legally cannot flip the switches back on those BlackRock off-balance sheet Treasury-based facilities unless there is a new black swan, a new, unusual, and exigent circumstance. This is written into the Fed code. It's a small section 13C, but that is the law right now. They can't just say, oh, look, High yield is falling out of bed. By the way, it's $3 trillion, that market, and growing. You cannot just flip a switch on. And
but
that,
won't they
I think,
manufacture something that meets those criteria in essence? Isn't it a case of we'll find a way? And this is a new event. It's a credit crash. We've got to intervene. This is exceptional.
Very possibly. Absolutely. Look, we are talking about the United States Congress, the most dysfunctional entity on the planet. And they will bow to markets if markets are truly in a state of upheaval. However, there's still not the legalese. There's not an ease with which to do this like the flip of a switch. You still have to come up with a reason. And
so we're going to have to see a fair level of stress in that system before they'll be able to re-engage.
Even if the Treasury and the Federal Reserve desire to put those facilities back into being, there's going to be a little bit more of a time lag. And when there's a time lag and risk has been unleashed in the credit markets, they were able to come in very quickly, March 23rd, 2020. And they were able to really staunch, they were able to get, put their finger in the wound and stop the bleed.
Yeah.
It will take them a little bit more time, and I dare say that Jay Powell knows the damage that he's created by rescuing the triple B right above junk sector of the investment grade bond market by grandfathering that in as part of those BlackRock off-balance sheet vehicles. So yes, to answer your question, your puts could blow up again, but you've got a little bit longer lead time because of legislation that's been written, and that was probably more answer than you ever wanted. But it's
I love it.
That encourages me.
The detail you provided there is absolutely fascinating. Yield curve inversions, if we can pivot to this. So my overall position on how at a market level these things are going to unfold is that there's far less time than people. So the minute we get yield curve inversions, there's a lot of people that run cover for it, and they say, yes, but it's, it'll be different this time, etc. You've got 17 months. Stock markets have typically gone up a lot higher in the period intervening. You're going to have 17 months on average, sometimes 10, sometimes 33. And our opinion is the sensitivity has got so acute that, and the momentum, you touched on this, which I think we concur to at a massive degree, is that the capitulation into that inversion was so brutal and with such high momentum. And now, in fact, the 30 and 2, which is not as common, but never inverted during the events of March 2019, has inverted for the first time since the GFC. What's your take on how much time? Because the risks are clearly all to the downside, but many people want to play in the traffic a little longer and pick up pennies. And my overall take is that's a very, very dangerous game. There's a fast lane with a Porsche turbo coming at 300 miles, and you're going to get absolutely ridden over if you go for this. You haven't got the same time frame that people want to assume. Do they have the aggregate amount of time, or are we more sensitive? And could the lightning strike a bit sooner than most people expect?
So my only caveat before I jump in is that there are too many people of our viewpoint right now, and that always scares me. It scares me when I'm not in the teensiest of minorities.
Yes.
That said, the sell side is equally united in saying 18 to 24 months, 18 to 24 months, even though the yield curve was only inverted for a hot minute. The fact is, if you look back at eras that involve policy errors, you look back to the double dip recession of 1980. So the US economy came out of recession July of 1980, and the yield curve inverted September of 1980. 10 months after that, we were in recession. That is formerly the shortest time period between inversion and going into recession. Of course, there was only 7 months from the moment of yield curve inversion until COVID hit. So that was another short time frame. The reason that I dispute the 18 to 24 month here it's going to be okay is that we're talking about periods that involved a 10-year and a 12-year economic expansion. What we're seeing right now is few dispute that we're in very mature late cycle, whatever lovely diplomatic term you want to throw to it. The end of the days, much less diplomatic, but we're definitely late cycle. And
Yes.
we're late cycle inside of a time compression chamber. This has occurred inside of 2.5 years. So for us to be saying that we're late cycle, for the Philly Fed, which I'm writing about for tomorrow's Feather, for the Philly Fed to be signaling distress on such a level, they're building up inventories to such an extreme that 6 months out, they're anticipating not buying anything to the same level as they lasted in the 1970s. Forget the great financial crisis, forget the 1990 recession. Stockpiling in the United States has become so acute because everybody's freaked out that they're not going to get things from China. And there's this war in Ukraine, but you've got purchasing managers telling you. You had 125 CEOs from the Philly Fed, which is the chemical hub of the United States. That's the beginning of the pipeline for manufacturing. Chemicals are at the very start.
Fertilizer, yeah.
Telling you that inside of 6 months, we're at least in an industrial recession, at the very least in a stagflationary environment.
Yeah, I've almost referred to this as a hyper-stagflationary environment. It feels like an inverse Goldilocks era that Greenspan bequested on us, because we went from a globalization state where we got incredible lower cost offshoring benefits as a result that they were able to run interest rates artificially low as a result of the inflationary benefit we got on these low cost producers. And that led to an asset price boom. So people forget that inflation is also in the asset classes often before it comes into the prices, the consumer prices. And now we feel like we're getting the deglobalization, which is the unwinding of that, especially following the Russia-Ukraine events. And on top of that, so we're reducing the workshop availability we can source from. And on top of that, we're going to have almost a stubbornly high inflation. Virtually, hyper is a bit too extreme, but I think we're in a real sense double digits. And that's the beginning of hyperinflationary levels. And surely the consumer is actually quite weak out there. I love it when Jay Powell says, with such a strong labor market and all of these narratives, and Biden was almost claiming pride on the GDP number being high. And that, of course, is on an inflated dollar. Are we in a really stubbornly high stagflation? Are we going to get an inverse Goldilocks? And how does it end? Does it end in reset, or is there a way of managing out of this?
I don't think there's a way of managing out of it, but I do think that you raise the point that there are many cross currents. And when you're talking about companies sitting on inventory, and for the first time in multiple generations having to shoulder the cost of carrying inventory, we're no longer just in time. With a weakening consumer, your pricing power gets decimated in these kinds of environments. And that's why, even though your input prices may stay high, if you're sitting on inventory and your demand is coming down, that's why we're seeing work weeks, expected work weeks come down. We're seeing job openings. They're still up year over year, but we're seeing the pace of job openings come down very quickly. So the disinflationary impetuses are going to be multiple in nature. A lot is going to be also variable. How was the crop season in the United States? How much infrastructure was destroyed in Ukraine? How much wheat can they get out? Will they get a second full season for planting wheat? Because they have not one but two in Ukraine. So a lot of the determinants of inflation going forward are going to be very much of a variable nature, as opposed to, China shut down, it's going to introduce all new supply chain disruptions. Well, that's true on the supply side, but is there that much demand coming from the United States such that disruption is going to be caused at our ports? Or are our manufacturers choking on inventory and beginning to communicate that to us? So, and by the way, if the consumer is getting weak, and if interest rate sensitive sectors such as autos and housing are weakening, are we going to start seeing, say 6 months out, are we going to start seeing this weakness come through, finally filter through? We're seeing pressure on home sales in the United States outside of the investor community. Will we start to see these biggest prices come down? You're seeing General Motors and Ford. You're starting to see incentive spending again to get people to buy cars. Ford Motor sells the F-150 truck. I know it probably in Europe, it probably makes absolutely no sense, but it is the gold standard. It is the best-selling vehicle in the United States. F-150 sales fell 47% on the month in May, even though they shipped out 74% more to their dealers. So this massive
supply stuff going on there as well. The implication is that there's a bit of channel stuffing going on there as well in terms of.
We're not there yet, but we are at the point where consumers are interest rate sensitive enough that they're not able to afford these nosebleed prices for autos, for housing, and they're saying so. And so, again, you can only have a situation of hyperinflation against a backdrop of possibly more stimulus, more fiscal relief, which you're not going to get in a midterm election year.
No, I get that. I mean, I've been many times to the States and I love visiting it. The American people are awesome. I enjoy visiting the country. I remember seeing one of the adverts as a little bit of a sidebar, Danielle, where F-150s were available, and they were available on, I think it was a 60-month, and there was even possibly a 70-month, 72-month payment. And that had a balloon payment on the back end of that. And this was, I'm talking last time I was in the States, must have been 3 years ago. And essentially somebody is buying about 60% of a car with a balloon payment over the kind of period my father paid off his home loan on. And I was thinking, wow. And then now we have this interest rate cycle. I mean, the fixed 30-year deal is through 5% now, and I'm seeing the intermediaries offering 6s and more, because not everybody got perfect credit or has got the highest score. Isn't that going to take an immense amount of fizz? Because there's two great ATMs for the American people, and that's the stock market, which, as we've said, probably has more risk to the downside with the VIX index not yet truly reflecting the debt element, and the housing market, which has been on a tear, but now most people being borrowers to some degree, facing 5+ percentage points. How about that consumer, and what effect the net wealth effect any downturn or slowdown will have there?
It's with good reason that we're seeing credit card spending in the first quarter especially be as robust as it is, and that has to do with what you're speaking about. I think that the universe of American homeowners who can make the math work for refinancing is down to, I think, less than 10% of the mortgage universe. So very, very few people can pull money out of their homes. One of the most frightening statistics that I saw recently is that among those who are refinancing, we're seeing a pickup in FHA loans, FHA mortgages. FHA mortgages are 3.5% down for the neediest borrowers. It's a government-backed program. And so if you can imagine somebody who bought a house a year ago, they've seen their home price appreciate to a certain extent. And this is a true anecdote. So they take that 3.5% mortgage, they refinance into a 5.25% mortgage just to get $30,000 in cash out of the house. The marginal rate of interest that they're paying on that is 22% on that $30,000. It makes absolutely no sense, but it paints a picture for you of how desperate many households are to keep consuming at the levels to which they've become accustomed because the federal government was assisting such consumption.
And there's no sign and there's no appetite for furloughs in any downturn again for quite some time. It's going to really take the pip squeaking. So there's not going to be extra normal income that's going to be state provided. You've got people using credit card debt, which is probably the most expensive, apart from that which you've just described, which is going almost to the extreme on loan to value on your property and releasing that extra.
The biggest banks just reported, and the media was adorable in saying that there was all this strength being exhibited with credit card spending. And then the fine print at the very bottom showed that JP Morgan, Wells Fargo, Bank of America had seen material increases in credit card loans. I'll tell you what a credit card loan is. It's when you take money as a loan from your credit card. You're just getting cash from your credit card at an average of 16.7%.
Wow. Yeah, that is super high. That's really expensive money when you consider what savers get paid. Isn't it one of the big corporate swindles that we have virtually no real recognition in our formal banking sector for postponed consumptions in terms of a saving rates, yet borrowing is so high? Doesn't it give the lie to what the true inflation rate is? Because essentially, I think you get about 0.25 as a bank saver if you're not on hold versus the aggregate consumer's access to credit, usually a credit card or a personal loan in the mid-teens.
It's the disparity is absolutely you can't even attach reason to it. And one of the one of the narratives that is a huge pillar of the sell side is that there's this massive amount of cash that's been built up. Well, there are deposits on bank balance sheets. There's absolutely no doubt about it. But when you look at the aggregate level of nominal savings in the United States, it is below that of what it was in late 2019. So all of the money that has been given to people with the highest propensity to spend it has been spent. And that's why you're seeing such acts of desperation to get their hands on cash. But again, we're talking about Americans here. And Americans do not like to stop spending. And that's why you've got people like Jay Powell who are sitting on the laurels of the most lagging of all data, which is unemployment or employment, and then you've got retail sales on top of it, which is being supported by taking out credit. So, but these are very much, it's as if you're trying to drive on the Autobahn in Germany, going more than 100 miles an hour through the rearview mirror.
Wow, yes. That's pretty dramatic, but I would probably be forced to agree. What's the first thing to break? Clearly, we should be looking at debt markets, but it seems like the release valve is FX currencies. I mentioned the Japanese in actively doing this form of curve control, and we've seen a huge devaluation in the yen. Shouldn't everybody be watching currencies as much as debt markets as well, as part and parcel of this overlap that the people see them tend to be as siloed, as if they're, they live in a vault of their own, but that in actual fact they're all overlapping taps and levers and water finding levels in different containers that the one will feed into the other. They don't see the macro system more holistically. Is there not a currency major play out that's being missed here as well with the debt?
Absolutely. I mean, pay attention to countries that are forced to import their natural gas. And with Japan being the #1 in the world in terms of its dependency, South Korea being #2. There are a few other countries down on that list, Pakistan, Thailand, and they are, to me, those are the canaries I'm looking at, because it's not an Arab Spring that we're contemplating right now, even though Egypt is in a mess right now. Egypt is on the brink. But we're not looking at an Arab Spring because last check, Peru is not in the Middle East. No. So you're looking at a global situation right now. And that's why I think rather than looking at HYG, even though we've definitely seen credit risk start to perk up as the move is advertising and warning and cautioning, but I'm watching how quickly the emerging market space, because they don't have the latitude, they don't have the Bank of Japan in some of these emerging markets. They don't have the same levers. They don't have the same release valves. So you see Sri Lanka simply up and say, we're defaulting. If we don't default on our debt, there's no food. And we have to have time to negotiate with the IMF. So we're just not going to pay on our debt. So we're just going to flat out default. Again, go back to the time compression chamber and how quickly these things are happening. You have twice as many emerging market countries right now with debt levels that are trading in distress north of 1,000 basis points north of a US Treasury. That's twice as many as you had in the immediate aftermath of the pandemic hitting. So we're in a much more dire situation here. So if you want a front row seat with popcorn, follow the EM space.